All right, stocks finished with another new all-time high here on the S&P 500 at least. But it's some more red flags that are popping up. So I'm going to share with you some of these divergences that you're seeing to kind of show you, again, not that we can't be bullish, but how, and talk about how to account for these risk factors and still maintain a posture that's in line with the trend, because we don't want to short a very strong bullish trend, but we also don't want to back up the truck either. So we're going to talk about that and what's driving these divergences, as well as our trade idea of the day. A trade idea of the day that allows us to stay in this trend, but also be prepared for a pullback and be able to take advantage of both. So let's go ahead and get started. Today is Wednesday, February the 12th, 2020. This is the market outlook from marketscholars.com. My name is David Settle. All right, let's start off taking a look at the S&P 500 with the market forecast indicator. Another yearly high. You got the yearly high tag showing up here on the chart. So another yearly high today. That's what, the third day in a row. 1, 2, 3, 4, 5, 6, 7 up days in the past 8 updates since we closed that Friday with this kind of bearish pattern here that kept that brought the intermediate line really close to being below 50, but not quite. We have since bounced back up. We have 3 of the 4 lines. The small range kept the momentum line from getting up there. In fact, the last 2 days, small range have kept the momentum line from being in the upper reversal zone. So you have a cluster, just not the 3 line, not including the momentum line, which is the one that you kind of need to get the cluster there. And a little bit of a bearish divergence, setting up lower highs in the near-term line, higher highs in the index itself. But again, that's one of like about 100 different divergences there are right now on the S&P 500 in general. In fact, when you take a look at the S&P, I mentioned this before, but when you look at the S&P compared to say, for example, bond prices, or bond yields, excuse me, you can see that in fact, I'll go out all the way to the beginning of the year. Yeah, beginning of the year. Right here, this is the peak. Actually, over here, the peak that we've had in bonds since right before the beginning of the year. We've since dropped. You notice here that bond yields were already dropping by the time stocks peaked here on the 22nd. From the time that stocks peaked and they fell, so did bond yields. We've since rallied up to new highs in stocks, but not even more close to new highs on the S&P 500. And then, of course, we've rallied up to new highs even now, and we're not even above those highs on the S&P 500. And if you compare the same move here, this one. If you compare crude oil, we've done this before too, you can see again it peaked here before the end of the year, just like yields. Stocks peaked over here on the 22nd. We were already down in crude oil before that happened, and then of course as stocks fell, so did commodities. We bounced up to new highs, not anywhere close. We bounced up to new highs now. We're not even up at new highs there. And then finally the Russell 2000. Kind of give you an idea there too. The Russell, let's do IWM since we're looking at ETFs here. Our ETF here, you can see we peaked on the 30th. By the time the stock market, the S&P peaked on the 22nd, we were already down on the Russell 2000. And again, we bounced up to new highs here on the 6th. Nowhere even close on the Russell. And same thing, we're already up to higher highs here, and the Russell's not. So again, if you look at yields, which is the inverse of long-term bond prices, and commodities and small cap stocks, and you can see we're not quite getting the same risk on move. We're definitely not getting the higher highs, and we're still way down below the peak that these all had at the end of the year. In fact, if you look at the year-to-date chart for a lot of these asset classes, from year-to-date, it's here, we'll just go back a day. If you look at the year-to-date chart here, some of the asset classes are up the most besides the S&P 500 are gold, the dollar, long-term bonds, and real estate. I mean, that's a pretty safe risk-off type of move, with commodities down as much as they were. And up until January the 31st, that's when we hit that low point, right, on the S&P. That ever since then, things have been rallying. In fact, if I were to come off here and show you since the 31st, since January the 31st, and we'll go to like a 20-minute chart or 30-minute chart here. You can see emerging markets have rallied. Small cap stocks have rallied, but not as much as S&P. The dollar's still up, and you can see gold and treasury bonds are still kind of holding up with small losses, and crude oil just in the last couple of days have made back some of this. So not really the most risk-on move here either, especially with real estate holding, doing really well, and small caps lagging behind. And then these two safe haven asset classes down, but not down very much on such a significant bounce there. So you kind of get an idea of, okay, maybe we're not, again, just one of a million divergences that are showing up right now. Again, here's the Russell 2000. We do have dark green shading and a green line again on the Russell 2000, but you see again as well that the possibility of a near-term divergence. So we'll kind of keep our eyes on that near-term line to see if we don't come down from what is now a slightly higher high here. Alright, as always, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over our logo right here on the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video that will notify you when these videos are posted. Hit the thumbs up icon down below the video. That tells us two things. Number one, you liked our video. Number two, you want us to do it again tomorrow. So it's a quick way to give us feedback. If you don't like our video, you don't have to click anything down there. And then comment. What did you get out of the videos? Use the comment section below to let us know. Join our website at marketscholars.com. There's a link popping out right there on the top right corner of your screen. Click on that link. You can subscribe to our site for free. Follow me on Twitter for more content in between the videos from day to day, and join our Market Outlook Facebook group that we've created. If you want to continue to follow our trade ideas that we make in these Market Outlook videos, use our Market Outlook live video for that. The link for it is this top right corner of your Market Outlook page. You can also mouse over Market Outlook, get to the live trade review, and see all the old ones as well. We manage all the trade ideas we ever do in these videos all the way up to the close, at least the ones that I do, because mine are more active oriented. So watch for that. And then again, we invite you to engage with us on social media, like today's Market Outlook tweet, today's Market Outlook Facebook post, by clicking on these images. Again, the more you engage with us on social media, the more they will promote all of our content to your timeline, because they do that with the content that you engage with the most, so the accounts that you engage with the most. So we try to make that really easy for you to do here. Alright, let's get back to the charts and take a look at the long-term chart here. So bear with me 1 second. Let's bring up the long-term view. Alright, you can see the nice good bullish candle we're getting. In fact, getting to the point where we're almost about to close up above last week's high on the Heikin Ashi. It's so very, very bullish from that regard. Continuing the bullish trend, the PPO is continuing to rise. Again, it's only been higher in the last 5 years. It's only been higher in January of 2008, and there's been a few other times in 13 and 14 it's been relatively higher. Now you notice in 18 there's a lot of publicity about that particular high because we came down so hard, and that started this bout of volatility that pretty much ended in October of 19, this barely at the end of last year. So almost a 2-year run of volatility where we didn't go anywhere. We had some ups and downs. But in 13 and 14, when we were this high, it didn't come down. In fact, we continued to go higher all the way up to 15, even with that divergence going on. It took some time to play out. So just because we are this high doesn't mean necessarily that we have to continue, that this long-term run is done. In fact, I think it's actually the opposite. The long-term run is while this intermediate run might be close to being done, the long-term market sentiment run, I think, is closer to the beginning. I think this is still the first intermediate run on a longer-term run out there. Let's take a look at the 3 green arrow charts, and you can see, of course, 3 green arrows on the MACD and stochastics, very strong moves there. You can see SPY is still easily now, kind of significantly above the 8-day moving average, but you can also see the divergences that are still set up here on these different oscillators all across the RSI, the CCI, the DMI, all these oscillators setting up with this move to a higher high right now. Here's your DMI and the lower highs we've been getting there. So lots of divergences setting up, which just again doesn't tell us that we're going to reverse to the downside, but it does tell us that we need to be very cognizant of the risk factors that are out there. Just one more check here on that 3-month rate of change. You can see how bullish, we're still 9% returns over the last 3 months, and you can see that's a lower high point itself compared to where we were at the beginning of the year when we had pretty strong returns. So again, a little bit of a divergence showing up there too, that could suggest a little bit of a turnaround. Very, very high levels here, close to the double-digit mark, which is a pretty high return for a 3-month period of time. All right, now let's take a look at the S&P on the intraday chart, and you can see the rally, and I've showed you before how this rally up to new highs on the Russell. The Russell did not clear this high point, neither did crude oil, neither did bond yields. So this kind of shows again how that there has been a pullback in risk appetite, just not enough of one to bring the main leadership of the market, which is concentrated in the S&P, and for that matter, it's concentrated mainly in the QQQ. If I were to take a look at QQQ here, you can see it has also gotten up to new highs, well above these highs from over here. So you can see where that leadership is coming from for the broad market. Obviously, those big tech names that continue to lead the way higher. Lower volume, there's a gap. Yesterday's gap filled in. We haven't filled in today's gap yet, so you would expect that to fill in relatively soon, whether it's tomorrow or the next day, the end of the week. You take a look at the daily chart for volume, and you can see 44 million. So we're really dropping down in the volume there, and the trading range was only 1.25 points. Include the gap there, 334.68 to the low 334.68. So the S&P 500, or excuse me, here's the, sorry, wrong day. So 335.26 and the low at 336.43. So we have about a point, 335.26 to 336.43. We have about a point of difference there. So that gets us a little bit closer, but still well below the average. So when I look at this chart here, you can see we're breaking back below 1%, which is a sign that we're not going to be having an intermediate pullback anytime soon. Volumes you can see falling, but falling from much lower lows than what we've seen in other intermediate pullbacks. So that's why I don't put a lot of stock into this pullback here. And then the volatility index you can see is broken below 15, but has not broken below the 90% mark, which is another signal to watch for, to see, okay, we're going to be bullish for a while, even if we're on a very mature run as it is. That mature run can stay irrational longer than you can stay solvent. So we're going to be bullish for a while here until another catalyst comes along and sparks a risk-off environment for equities. All right, to summarize, the posture remains strongly bullish. Obviously, plenty of warning signs and divergences showing up, so it's not back up the truck bullish, but bullish enough to stay with the bullish trade you're in, albeit potentially with reduced risk, to just in case these divergences playing out. And of course, doesn't mean we can't make bullish trades, just again with smaller risks than normal, accounting for these risk factors. All these divergences are risk factors. So what do you think? Do you agree with that assessment? Do you disagree? There's a link popping out right there on the top right corner of your screen. Hit that link to open up a poll. Hit either agree or disagree. If you click disagree, comment down below on why. Either you're a lot more bullish than I am, or you're so bearish that you're expecting a pullback a lot sooner rather than later. So again, everybody's got their opinions, but share in the comment section what's driving your opinion. What comments or charts or indicators are you looking at that would suggest either posture? All right, so as I showed you before, from an asset class standpoint, the S&P is kind of its own little outlier in terms of moving up to higher highs. But a big move that we had here today was that dollar index breaking out after yesterday's little pullback. That's what, 1, 2, 3, 4, 5, 6, 7 days out of 8. Again, that's not typical for equities to be this bullish when the dollar's on a strong intermediate run like it is. And it's continuing to move higher. It's got a strong posture. I got the cluster at the beginning. I mean, those are all signs. Market sentiment's rising from being below 50, so this was a market sentiment pullback that it had. So it leaves open the possibility. The last market sentiment run we had was this one run that lasted here from mid-July all the way up to almost mid-October, so about a 3-month intermediate run there. And there's one before that. It's actually kind of all one big one right here. There's an intermediate run or market sentiment run, and this one was. So in all these instances, equities didn't do so well. At best, flat after having initially risen and then come back down. Very similar pattern to what we're seeing here, where stocks have been rising so hard. So just kind of keep an eye on that pattern. If you take a look at crude oil, that key number for crude oil is to get back up above this 52 area, and it got really close yesterday. Big strong move yesterday, not able to withdraw so far tonight into the next day. So we'll kind of keep our eyes too on crude oil. And then finally the 10-year note, we've taken a look at this. You can see it's bouncing back up the last couple of days, but again, it's still got a long room to run. It actually still has a very strong bearish posture, dark pink shading and a red line. So we're not out of the woods in terms of risk appetite, except for in these big tech names that happen to be in that technology or in the cyclical sector. Let's take a look at the different foreign markets. I wanted to show you this as well because of that strong dollar, which impacts these dollar-denominated ETFs. Let's look at the 12 grid first. All right, you can see, you're getting dark pink shading and a green line on a few of these. So they finally moved up enough, except for in China and the UK. We're still not quite there. In fact, China's giving you a bearish signal there with the light green shading and the yellow line. You can also see too, Korea's moved up. That's a very good sign for global growth outlook. You can also see Brazil and Russia, which have previously been relatively bullish areas in the emerging market space, at least, are still showing some weakness here. Let's do the same thing for the sector rotation and how things have moved from a sector standpoint. Where it is right here. There's our sector comparison chart. Sorry, I want to look at the 12 grid first. And again, I mean, these areas right here are pretty much tech. I mean, this is Google, Facebook, and Netflix. Over here is Amazon, and then over here is just Microsoft and Apple. And you can just see those three are leading the way, as you would expect. Industrials have had a good day today, but we're still seeing weakness in these dollar-sensitive areas. And relatively bullish markets in the safe haven area, especially real estate, really taken off in the last 3 days. Again, not something you would expect to see in a risk-on environment. So those are really holding up pretty well there. Now let's take a look at the sector comparison, the regular comparison chart. And I did want to go back to that January 22nd time frame when the stock market peaked. We pulled back, and now we've gone through those highs to a new set of higher highs on the S&P 500. So if I were to pull this back out to an hourly chart, again, you can see initially after we had peaked, that's when we peaked. We initially came down. Utilities did really well. Staples, real estate were up there briefly, but since then you can see utilities and real estate are still holding up pretty strongly. But discretionary and technology have really risen to take the mantle. On the other hand, these cyclical areas are still struggling right around break even, except for energy, which is down 5% off of its lows, but still off of 5%. So again, this is another one of those signs of risk appetite not being nearly as strong as we thought they would be here, with these safe haven interest rate sensitive areas still being really, really bullish there. For our trade ID, we actually put on 2 trades today. We took a look at Anthem. Anthem actually is getting that signal, that kind of bearish signal, light green shading and a yellow line. There's a few little differences on this signal that would suggest that this might be actually a reversal signal. That is, the short-term sentiment really moved up higher, and intermediate line is moving up close to crossing over. If you take a look at its long-term chart for Anthem, You can kind of see we've been bearish. This is a transition candle that we're having right now. So you would expect a transition to some bullish Hakunashi candles. If you take a look at the 3 green arrow chart, you can see how that MACD is really starting to rise pretty quickly in a big, strong push in momentum here. Again, another sign. Of course, nothing's ever guaranteed, but a sign that this may be this type of reversal. Here's the chart that you can see we broke above the point of control, which is also pretty bullish. The question is how much potential does it have the upside while still allowing for some room to the downside on these trades. You look at its DMI chart here, and another thing that kind of stood out is while the negative index hasn't fallen below 20 yet, the positive index is well above 25. So we get another sign that this might be a reversal pattern instead of a reversal of the trend. So to a bullish move, a bullish intermediate run to come out of this. So what is now a bearish intermediate run that it's currently on. But again, we just kind of worry about the upside potential, the downside potential, and that means we're going to take a look at selling a vertical spread. So if you sell the 270 buy the 260, and then sell the 320 and buy the 330, that kind of gives you this trade down here. So let's get rid of, well, let's do this. Since we already have it up, let's analyze that trade. So that's the trade that we have put in here. Here, let's get rid of all these others, but the Iron Condor. So you can see about 3/4 of a normal trade, and then a maximum gain of 284. But also we're going to say, okay, well, if there's some upside potential towards that 320 area, then let's go ahead and put a call vertical where I'm selling at 320, buying the 310 for only 267. You analyze that trade, and you can see here that we're putting a small risk for a relatively decent reward. That risk covers the rest of these two combined equate to the two risks combined equate to one full normal size position. But now I add some return if we do move up towards the top end of my Condor range, which is the end that I would expect that we would threaten. Of course, it could threaten either one, but my expectations are that it would threaten the top end because of the bullishness. And now we have a way to protect kind of the top end of this with this long call vertical spread. All right, well, that does this for today. Again, you've heard from me. Now I want to hear from you. Use that link right there popping out in the top right corner of your screen. It opens up our forums, our Market Outlook forums at marketscholars.com. Open up any new thread, reply to anybody else's thread with any questions or comments you have about anything we talked about in the video or anything we didn't talk about in the video that pertains, obviously, to the topic. Again, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on our video down below, follow me on Twitter for more content, and join our website at marketscholars.com as well as our Facebook group. Have a great rest of your evening, everybody, and we'll see you all next time.